The Flyer FOREX Fund is the only student-run leveraged currency portfolio in the nation. We began trading real money in October of 2010. We currently have 19 active undergraduate members and an 18-member advisory board. We trade on the 4-hour EUR/USD and AUD/USD spot markets utilizing a non-discretionary, non-coded algorithmic model. Now, this model incorporates technical indicators such as EMAs, momentum, volatility, correlation, and GIRTH. Now, while actively trading, the Flyer FOREX Fund trades a 10,000 notional euro position and a 13,000 notional Aussie position. These are our basic trades. Now, since inception, the Flyer FOREX Fund has produced 30.37% gross returns and has increased capital under management by 314%. The Flyer FOREX Fund is organized somewhat like a corporation with 4 levels. The first level, being the advisory board, where Professor Leslie K. McNew is the chair and sole proprietor of the Flyer FOREX Fund. Beneath her is the COO, Michael Groff. Beneath him, power is delegated to 5 departments. These departments are operations, sales, trading, modeling, and risk. Each department is headed by a director, and beneath each director is the 4th level of the fund, which are all other positions to add value. These positions are, but are not limited to, policies and procedures, banking, and monthly reporting. Now, taking all these components together, the student members, the model, the technical indicators, and the organizational structure is ultimately how we generate alpha.
The Flyer FOREX Fund trades in 2 markets, the EUR/USD and the AUD/USD spot markets. In both of these markets, we utilize a pair of harmonic exponential moving averages. We use these moving averages for 2 purposes. The first is to technically establish entry into both long and short positions. So, for example, if the fast EMA crosses up through the slow EMA, we would enter into a long position. If the fast EMA crosses down through the slow EMA, we would enter into a short position. Now, the second way that we utilize these harmonic exponential moving average pairs is to derive another technical indicator that the fund uses, an indicator that we call GIRTH. GIRTH is simply the linear distance between the 2 exponential moving averages. We use GIRTH to quantify the strength of a trend. So, for example, if GIRTH is wide, then we know that there's a large trend in the marketplace. If GIRTH is narrow, and has been for any material amount of time, then we know that consolidation characterizes the marketplace. We use this technical indicator, GIRTH, specifically as an exit strategy, or an exit indicator. More pointedly, we'll exit both long and short positions at particular GIRTH numbers, or distances between these 2 EMAs. So this exit indicator, GIRTH, is really the foundation of our model, and thus our alpha generation. The Flyer FOREX Fund model is composed of 3 components that run synchronously together. The first 2 components are what we call standard style models that operate in both the EUR/USD and the AUD/USD spot markets. Now, even though these are both standard style models, they're not identical. In the EUR/USD spot market model, we utilize EMA pairing of 10 and 20, and we also utilize an exit strategy known as upward GIRTH. In the AUD/USD spot model, we utilize an EMA pairing of 6 and 12, and an exit strategy known as downward GIRTH. Now, the final component of our trading model is what we call the European chaos hedge. This European chaos hedge is a rolling correlation model between the 2 spot markets that we trade in. We use this European chaos hedge to help size our AUD/USD spot positions.
The European credit crisis, beginning in 2010, has created either consolidation or extremely whippy euro market conditions. Our standard euro model does well as strong directional volatility trends, so the current market has adversely affected our model's profits. To mitigate the low or even negative returns brought upon by this current market, we have implemented a correlation trigger, which we call the Euro Chaos Hedge. This hedge will add an additional lot to our standard Aussie model when historically high correlation between the euro and the Aussie breaks down, specifically to 63% correlation. We found this number through a 20-day rolling correlation average. This is only one of our proprietary trading techniques, and another is upward and downward GIRTH.
GIRTH is the foundation of our current trading model. Due to the differing market conditions in the Aussie spot and Euro spot markets, the Flyer FOREX Fund has decided to utilize two separate GIRTH exit strategies. The Euro standard style model utilizes a proprietary trading technique known as upward GIRTH, while the Aussie standard style model as well as the Aussie correlation trigger model utilize downward GIRTH. Upward GIRTH is the exiting of our position as the momentum of the trend is increasing. It is uniquely applicable in the current Euro market environment due to the fact that it can capture profits of accelerating trends for both long and short positions. The Aussie spot market has been producing directional volatility, resulting in strong, long-term trends. Downward GIRTH is designed to capture the sweet spot of these trends as the GIRTH is decreasing. This summer, we uncovered the link between volatility and GIRTH. Through research and backtesting, we have discovered that as the Euro spot market volatility increases, the GIRTH number tends to widen. This has led us to decide that when the Euro spot market volatility increases, we must widen our GIRTH exit strategy so we can capture the most profits. Through this, we have implemented a volatility trigger in our Euro standard style model. When the volatility trigger of 9.47 is broken, we begin GIRTH optimization backtesting. When the trigger broke exceeding 9.47, we begin wide GIRTH backtesting, which is numbers ranging from 25 to 50. When it breaks below 9.47, we begin narrow GIRTH backtesting, which is numbers ranging from 5 to 25. Through this continued backtesting and optimization, we ensure that our current trading model is running at its highest profitability.
Since inception in October 2010, the Flyer FOREX Fund has never experienced a year nor academic year of negative returns. We currently trade on an account balance of roughly $12,000, half of which is used for risk capital. We have a return since inception of 30.3% and an increase in capital under management of 314%. This increase in capital under management comes from our returns, Professor McNew, student dues, advisory board dues, as well as operational error fines. Our daily valuation method of calculating these returns is CFA approved and involves geometrically linking our returns from each and every day. If I could turn your attention to our graph of our returns, you can see in 2010 we were trading off a very simplistic model. But as our model became more sophisticated, utilizing upward GIRTH, downward GIRTH, Euro chaos hedge, as well as a volatility trigger, you can see our returns since inception continue to increase.
The risk department is the newest department of the fund, only coming into being in the summer of 2012. The department manages three main risks: market risk, credit risk, and operational risk. We utilize a two-factor parametric VAR model to help realize our market risk. Our 95% average daily VAR since inception is around $160, although we've recently experienced spikes in our VAR due to the potential tripling of our notional lot size under the Euro chaos hedge. We've also implemented a stop loss of 100 pips for our Aussie position and 300 pips for our Euro position to help mitigate downside market risk. To manage our credit risk, we sustain over half our capital as reserve capital, and in the case the FXCM, our trading platform, were to default, we would have enough funding to continue operations. The fund's largest risk, operational risk, is managed in three ways. We utilize trader teams where one trader must enter the data and another trader must verify the data entry before any trade may be executed. We also use a photo verification system to encourage the mitigation of data entry errors as well as improving accountability. Finally, we have developed policies and procedures documentation to help with knowledge transfer as well as procedural consistency.
We have two main forms of competition, one being our professional investors and the other being our benchmark. Our benchmark is our model ran continuously and automatically with no errors, slippage, or downtime. Since inception, we've had a gross return in the fund of over 30%, whereas our benchmark has had a gross return of over 40%. The main reason for the difference between these two numbers is due to downtime. An example of our downtime would be in the summer of 2012, when our model development surpassed our implementation capabilities. So we decided to temporarily shut down trading, put together a team of elite traders, and beta test our procedures throughout the summer. We finally reopened trading in August of 2012. Our other form of competition are professional investors. The reason we use professional investors and indices is because currently there's no other student currency portfolio fund in the United States trading real currency at the undergraduate level. Therefore, we find it suitable that we can use the funds and indices displayed here as our main competition. Now you can see, in 2011, many of these funds had low returns and even negative returns, whereas the Flyer FOREX Fund had a return of over 20%. Now let me reiterate, since inception, the Flyer FOREX Fund has neither had an academic or annual year where we've had negative returns, and we've had a gross return of over 30% since inception.